Hello and welcome back to the ROI channel, the channel that's obsessed with the art and science of return on investment. Today we've got something a little different, okay? By request, people are wanting a video about what eToro is. I've had a lot of acquaintances asking me about how it works and the whole idea of it. So today that's what I'm going to focus on. I'm going to tell you a little bit about who I am and why I invest, and why I particularly like eToro as one of many tools in which you can use to safeguard and improve your wealth. So that's what we're going to talk about. We're going to get straight into it, as I like to do. So some key questions. This is what I'm going to go over for the rest of the video. This is one of the most important videos I've ever done. So please stick around, pay attention, put all your distractions aside, take a drink of water, and just take in the information, because I do believe you're going to get a lot out of it. So why invest? That's seems like an obvious question, but we need to tick it off. What's eToro and why would I use it? So that's an important question that I think some people will have in their minds. Copy trading, what is that? What's that all about? I've never heard of it before, so I'm going to go through and give you the rundown on that, because I think it's a huge invention. I really do. And why invest by copying Crassus? So you can copy the Crassus investment fund that I run. I'm the portfolio manager for that. Why would I want to do that versus another portfolio perhaps? So that's what we're going to look at. So as we get into it, we're going to see why invest at all. So many people don't invest. I do not understand why. I think they don't really understand the mechanics about what's happening. A lot of people believe that saving is investing, and that's not quite the same thing. And so I'm going to focus on just one particular aspect. There are so many reasons to invest, and I can't go through all of them, but the big one that's so important to today's day and age is inflation. So our currency system is a fiat currency system, which means it's a debt currency system. The paper money that we used to have, now it's all on the computer, is not payment in and of itself. It's a promise to pay. It's credit rather than payment itself. And a lot of people just do not understand that very important distinction. So your cash savings are currently, like right now, constantly and consistently being eroded due to inflation, okay? Unfortunately, we are all standing on quicksand. So we cannot choose, in my opinion, to do nothing. And the reasons will become very apparent as I explain it to you here. So here is an inflation calculator taken by the RBA, so the Reserve Bank of Australia. For the Americans, a lot of Americans watching, for you that's the Federal Reserve. For the Europeans watching, there are quite a few of those, that's the ECB, okay, European Central Bank. So this tool calculates the cost of purchasing a basket of goods, okay, so that's supposed to represent your average groceries, your cost of living, and services over a period of time. For example, it may show items costing $10 in 1970, now cost $26.93 in 1980, and so on. So what I did was I said, okay, a basket of goods and services valued at $100 in the calendar year 1971, there's specific reasons for that, would in the calendar year of 2020, so last year, they've calculated up to 2020, now cost you more than 11 times. It would cost you $1,119.04 using this inflation calculator. Not mine, the RBA's. And by the way, this calculator is understated, okay? The true effects of inflation are understated in the government and the central bank figures that they put out, because they generally don't take into account rent, which is fine if you don't have to live anywhere. They also don't take into account taxes and tax inflation, which again, that's fine if you don't pay taxes, but I pay a lot, and so I think that should be in the CPI and the cost of living. And so this is the base case, or the massaged case. They use hedonic adjustments. So if we were to really use the same measurements that we used in the past in terms of calculating CPI, then this is actually the lower end of the figure. The reality is probably much worse than that. Okay, you can jump on the RBA site and you can plug in your own particular estimates for inflation, or the time periods, and then you'll be able to work that out. And for the Americans, I've got something for you in just a few slides. Okay, so you don't need to memorize this calculation at all, okay? All it is, think of it as the inverse of compound interest. You've got the amount of terms, and the rate of interest, or in this case inflation, and then discounted by the number of time periods. It doesn't matter, okay? what you need to look at is that a basket of goods and services valued at $100 in the year 2000, okay, so 21 years ago, would 15 years later, in the calendar year 2015, cost $150.60. In other words, if you were to save your money, not invest it, just save it, and excluding certain other factors like interest and taxes and real interest rates and all that stuff, 15 years later, if you shove that money under the mattress, come back in 15 years, provided the rats haven't eaten it, you've lost half your purchasing power. You've lost half of your savings. I mean, that should scare you. That should be frightening. And again, not to belabor the point, but I didn't come up with these figures for the CPI. This is taken from the RBA, okay, which have a vested interest in understating inflation. Okay, so the reality is probably a lot worse than that. So hopefully, the idea of doing nothing and just sticking your money in a bank account or under the mattress is not making any more sense. Not that it ever did, but I hope I'm making the point that if you do nothing with your savings, you're going backwards, and you don't get a say in that. That's the way that our economy, unfortunately, has been affected. So if we look at possibly the worst offenders, okay, the Federal Reserve, and there have been worse hyperinflations, but they're supposed to be the reserve currency of the world. Anyway, if we look at the American greenback, okay, the American dollar in 1913, when they reinstituted a central bank for the third time, and we fast forward to, not today's date technically, but last year, a dollar has lost 97% of its value. 97%. Okay, and if you follow the cursor there around from 1971, you can see that the rate of change is astonishing. The rate of erosion into your savings is astonishing, and the reason for that is that the dollar was no longer backed by hard assets, or gold in this particular case, and it became a true fiat currency, which means that your paper money wasn't worth anything in and of itself. It was a promise to pay and not much more. Okay, if we take one part of that time period and we zoom in on it, so if we go from 1992, we use 100 as a numeraire. Okay, this is going to be our base effect. If you call it maybe $100 for simplicity. Over the next few years, we had a recession, and so interest rates spiked, and so the currency actually gained purchasing power, and so I don't think you're going to see that happen again anytime soon. And then look what happened from there, from a higher base effect. It just fell off a cliff with this idea of quantitative easing, debt and deficits, easy monetary policy. So if you had your $100, all of a sudden it's not going to buy you a peanut by 2008, and that's only 2008. 2008, of course, was the end of the GFC, and so you had the response. You had quantitative easing, money printing or currency increasing liquidity throughout the entire system, and this is before we even get to the debasing of the currency from COVID. Okay, so it's just a disaster. Anyone that had kept saving their money or their currency units, they've been destroyed. The central banks and the governments have just screwed you. It's insane. If you flip this chart upside down, you would see what happened to the price of hard assets or commodities when the currency instrument, okay, so what we measure assets in is currency, dollars, euros, yen, whatever the case may be. And so if that currency unit loses its purchasing power, you need more of them to purchase the same asset, whether it's a rock, whether it's a house, whether it's a car, so on and so forth. All other things being equal, as the value of the currency is debased or depreciates, you need more of those units for the same assets. That's why if you live in Australia and you've noticed that the housing boom, sure, part of that is from mismanagement and a decrease of supply relative to demand, but another part of it is a debasement of the currency, which makes it hard for people to get their foot on the first rung of the property ladder. Okay, Here's an admittedly extreme example, but it illustrates the point quite well. The Weimar Republic, okay, so pre-World War II, Germany was essentially known as the Weimar Republic, and so they went through a horrible inflationary depression, which gave rise to all sorts of evil, including the Nazi Socialist Party and Adolf Hitler. And so, I mean, throughout history, the inflationary depressions or inflationary crashes have just wreaked absolute havoc from a humanitarian perspective. It's not all about the economics, guys. The economics heavily influences the civilization in all its forms. So this is the cost of living, how much it costs you to live in Weimar Republic back in the day. So here things are pretty good, down at August 1st, 1923. And then, of course, the money spigots start to come into play. They start printing. They printed so much currency that look what happened to the same to the cost of living over that relatively short time period. This is where you had people calling up to dinner, offering to pay for their dinner in advance, because by the time that you booked your reservation and the time you finished your dinner, the price of the meal would have increased by several %. I mean, this is insane. You had all these they would have been Reichsmarks was before Deutschmarks in the Weimar Republic. You had wheelbarrows worth of worthless Reichsmarks. People would toss the marks in the street because they weren't worth anything and take the wheelbarrow because that was what was at least had some utility. So it's a horrible situation that I don't see a true hyperinflation. I certainly hope we don't get one. That's a horrible situation. But reading the footnotes, there are many examples. So in Peru, if cafes are raising their prices multiple times throughout the day, the merchants are scared of being caught holding the bag with it. They're holding all these worthless currency units that aren't going to pay their bills. It's insane. Zimbabwean consumers hauling around wheelbarrow loads of Zimbo dollars, and you'll see the famous image of the guy standing with a sign saying, "I'm a starving billionaire." He's got his Zimbabwean dollars. They might say that there's a $1 billion bill. It doesn't buy him anything. Okay, so I'm sure you're getting the point here that if you only have your savings, because our currency is no longer backed by any type of hard assets, you're being destroyed, you're being screwed. And I don't like that, but this is the game that's being played. I have to recognize that, and I have to deploy my capital effectively and protect and grow the capital of the investors that are copying my fund. Okay. Having been through all that, so more reasons as to why invest. I focused on the inflationary scenario, which is really deflating the value of your money, okay, or your currency. Most people go to work, they save a bit of money if they can. Actually, in the West, not many people save. We're really bad at that. We need to get a lot better. But anyway, and so let's assume that you are one of those few people in the West that saves your money. That becomes your capital. I want you to think of it this way. When you go to work, most people don't think of themselves as salespeople, but you absolutely are. If you have a job, you are selling your labor to the business or the enterprise, and so you get a reward at the week or the fortnight or the month, which is your pay packet. That is you selling your labor, and you are taking your sales, okay, minus your taxes. It's called your wage, but effectively what you're doing is selling your labor to the market. So what you want to do, once you've obviously got paid for that particular period, you have to meet your obligations. You got to pay your bills. You got to pay groceries, a few luxuries, all that sort of thing. And you keep a little bit. You manage to you work so hard and you keep that little bit. You want to keep that. Okay, if you've been disciplined enough to save it, you don't want the government going and spending it for you via inflation. And that's exactly what's happening. It's as if you kept your paper money, sat it on the desk, and the rats came along and ate it. So investing helps you protect your capital, okay? Protect your purchasing power, so that when you're old, you don't think to yourself, geez, I saved all this money and now it doesn't buy me anything. What the hell was the point of that? To grow your safety net for retirement so that you are independent. And this is where I get a little bit, politico-philosophical, preachy, hopefully not too much, but by the very best thing that you can do for society is to make yourself independent, okay? So if you work all your life and you save and invest enough so that at the end you can retire whenever that is for you, whatever that looks like for you, so that you don't have to rely on taxpayers to fund your lifestyle, i.e. a pension, that just has so many benefits, okay? For you, sure, but for the rest of society, okay? If you're not relying on taxpayers to fund your lifestyle, those resources are freed up for other people, and this probably won't happen, but I'd like to see us go back to a world in which when the government has a surplus of taxes, they realize, okay, we can actually lower taxes and lower the cost of living across the board for everyone. And that affects the people on the lower socioeconomic rungs the most. So if you have a lower cost of living, they benefit the most. Okay, when you have inflation, the guys like me with lots of assets, we do well out of that. It's completely backward system. Anyway, to free up and provide resources to society, and I won't touch on it too much, read a book called Economics in One Lesson by Henry Hazlitt. Here it is. This is what it looks like. This is the just best book. Read it. It is just so good from personal finance, but also economics on a grand scale, and I think it will really change a lot of your political perspectives as well. And that is this idea that by you freeing up your resources for society, so people don't have to pay you your pension, that resource, that particular resource is kept for other people, that's virtuous. Okay, that is virtuous. In addition to the fact that you investing, that you putting some money in the banker's credit, you investing in the stock market is providing liquidity and credit for those businesses to go and run their operations. For example, if you invest in Apple, for example, and they have more money in which to invest in their R&D and their technology, they can lower the unit cost of iPhones and MacBooks and so on and so forth. And so all of a sudden, those people that could not afford those initial items when they first came out, their prototypes, by investors allowing Apple credit, they can go and invest in ways to make those products cheaper, and so more people have access to that. That's what I mean by lowering the cost of living and being able to get access, or new parts of society to get access to the better parts of technology, which will raise living standards. Okay, so you investing in energy companies, helping that energy company expand into emerging and frontier markets, provides electricity and utilities and so on and so forth to poor people that could never afford that before. I'm not a particularly religious person. My family happens to be, but I'm not. But where I absolutely, the closest I come to being religious is in the divinity of free market capitalism. And I mean that absolutely wholeheartedly. This idea of you deferring consumption for yourself, investing it for the greater good of other people. There is nothing that I can think of that's more virtuous than that. Anyway, I'm going to get down off my soapbox. It also allows you to grow your income source. So if you're working away for a menial job for a menial wage, you work really hard and a discipline to save that amount of money. Over time, that investment that you make starts paying you back by cash flows from a property, from dividends from investing in the market, so on and so forth. And all of a sudden, if you were making, let's call it $30,000 a year, and you're able to invest that over time, eventually you start to have dividends, as an example, cash flow adding to your income that can even exceed your income. So you might be working the same job for 40, 50, 60 years, yet at the end, if you're only making the equivalent, inflation adjusted equivalent of $30,000, but your dividends from what you've saved and invested over time, they might be $100,000 a year. And so you have less demand for you having to sell your labor. We've got limited time on earth. We cannot continue to work and sell our labor for money all the time. We eventually need to be able to fall back and have the ability not to work and be self-sustaining, essentially. Okay, so why eToro? That's the next question. All right. Okay. Hopefully, I've convinced you that investing is a divine activity, and you should absolutely be doing it, if not from a common sense point of view. So why eToro? eToro is a great platform. I'm not saying it's the be all and end all. I encourage you to invest in lots of different things. But eToro is really good because you have access to multiple different assets on the one platform. So normally your traditional brokers, you only get access to stocks, okay? And that can include ETFs, maybe indices, but generally speaking, it's just stocks. On eToro, you've got access to crypto, if that's your thing. You've got commodities, futures, and portfolios or ETFs that are already made up for you, if that's your thing. There's currencies. There's just so many different markets and asset classes. So it's a great way to get diversification in a very easy to use platform. Zero commission. Okay, they do keep a small spread on the trade, but zero commission and the ability to buy fractional shares. So normally in my old brokerage, for example, it was a $500 minimum. So you couldn't invest in anything less than a $500 lot. And then you had to pay commissions every time you buy and every time you sell, and so on and so forth. Here, the minimum amount is $50 if you want to trade an individual stock. Okay. And I think it's $200 if you want to copy an investor like myself, or if you want to invest in someone else's fund. $200 minimum, no commission. I mean, it just doesn't get any better than that, guys. That I haven't seen anyway. You have insurance, so you can leave your savings in there while you're waiting to find a good place to invest it, and it's completely insured by Lloyd's. This is a question I had for my account manager. He said, yep, no problems. Each account that you have, Benny, up to 1 million worth is completely insured, so that's great. Social trading, so you get access to like a social media. If you're trading, you can say share your trades. You can talk to other investors all around the world on the platform. And the biggest thing, in my opinion, is the ability to copy the top traders. So if you think about it this way, if you're going to invest, if you wanted to go to some of the greats of all time, Warren Buffett, Ray Dalio, Michael Burry, John Paulson, all these guys, these very famous guys, hedge fund managers. Most of us on this video would not meet the capital requirements. You've got to have, a minimum of $500,000 for even just some backwater entry level fund here in Australia. So getting access to top talent for anything less than, I would suggest, at least $1 million is out of the question. They're not even going to look at you. Then you have to take into account their fees. So forget zero commission. Their brokerage is going to take commission. They're going to charge you fees for assets under management, and then they're going to take a percentage of your profits. Okay, so typically back in the day, your hedge fund would charge you 2% of your funds under management, and then 20% of the profits that you made. If you want to invest in Jim Simon's medallion fund, if you were rich enough to do that before he closed the fund, it was 4 and I believe 40. Okay, so 4% just in management fees, nothing, just to take your money. And he has a fantastic track record, so he's worth the money, but then 40% of the profits. Okay, so that starts to put things into perspective, hopefully, in terms of how important, and what I think this is, for the average person to get access to top talent and actually have their money work for them at an entry-level situation where they're very, very minimal capital requirements and no commission. Okay, again, I haven't seen anything even close to being as good as eToro. So let's talk about copy trading. What is it? eToro users can copy the trades of talented, experienced, and professional investors using the copy trader function. I've taken that from the eToro site. I happen to be a copy trader. You may or may not think I'm talented, experienced, or professional, but the beauty is the choice is yours. The key points, okay, so that's a feature. The benefit for you is that you don't have to be an expert, okay? You don't have to spend the time. The experts work for you. Like, I spend almost every waking hour of my free time thinking and researching and reading about the markets in some way. For most people, that is extremely boring, okay? And I totally get that. So the benefit is this is a platform that allows the experts to work for you, saving you time and reducing losses from mistakes. Okay, you get to leverage other people's experience, and they've made mistakes in the past, and they're professional and have a great track record. You don't have to risk your capital from suffering your own ignorance, essentially, as you're starting to learn about investing in the capital markets. The way I like to think of it is this: you can literally copy the homework of the A students. So when I went to high school, a certain someone named Jono, I won't use his last name, but if he's watching, he knows who he is. He literally would just copy my homework word for word. Okay. Now you got a platform like eToro that makes Jono look really smart and me look really dumb for putting in all the hard work, and he gets to copy and get paid for it, essentially. But it is a benefit. There's no doubt about it. Everyone's performance is displayed transparently, including risk score, fail to success ratio, etc. And this is the biggest thing. So the benefit for you is that it creates a level playing field. It's a meritocracy. Performance is the only thing that matters with eToro. You can go on anyone, including my portfolio, and you can see every single trade that's ever been launched, and you can see the outcome. Did I lose money? Did I make money? How much did I make? How much did I lose? You can see what my portfolio is at the moment. You can see how much is allocated here, how much is allocated there, and so on and so forth. You can't do that with a private equity fund. You can't do that anywhere else in any firm that promises to get the returns, or not promises, but has the potential to get the returns that a lot of the eToro copy traders are able to get. I mean, this is crazy. So you get access to everything, okay? Some top eToro traders have repeatedly beaten benchmark indices, okay? There are a lot of guys out there, myself included so far, that have been able to beat the benchmark. Now, I'm not saying that, I can't guarantee results. No one can guarantee results, but you get access to the top level talent that have the track record without the top level fees, okay? And you also have control over withdrawing your money or depositing more in, which a lot of people don't understand. If you were to invest in a private equity fund, okay, they're not going to tell you necessarily what they invest in. They're going to say, give us your money. These are the fees. These are the terms. Your money is with us for often 5 to 7 years typically. And if you need that money in 3 years, sorry, bad luck. There's a covenant in our agreement that we do not have to give you back the money until a certain date. And there's nothing you can do about it, okay? But obviously the liquidity of eToro, you can put funds in and take funds out. I don't recommend you do that. It's a silly strategy. But to illustrate the point, you have control over when you deposit and when you withdraw your funds. Your money grows faster for you and working harder for you, assuming that you pick the right person to follow and the right people to copy, okay? So let's have a look at how much difference that makes for you. So if you're getting performance versus underperformance, what does that mean for you, the end user, the investor, at the end of the day? Okay, never know where to put that thing. Let's put it here. So this is an illustration showing the difference that a portfolio manager, a successful portfolio manager, can make for you over time. And the effect is enormous. If you had, as I always use, an initial investment of $10,000, and then followed that by investing $500 every month on the app. It's so easy. You go up, transfer funds, copy, and you're done. I think that almost everyone on this video would be able to do that. There are very few that couldn't. If you really wanted to, you could do that. So let's just assume, just a hypothetical example, that you do that. And again, there are no guarantees, but let's say you copy a top talented fund manager that can get you 20% compounded annual growth over 20 years. Then let's say you put that in the market, or another fund manager that only gives you 10%. The stock market typically, with me being generous, there's a cliche that it gives you 10% return every year. I think that's being generous, but let's just go with it, and you'll see the difference. Between the two, the difference is 3 times. So if you just invest in a broad index and assuming that gets you 10%, which it may not, over 20 years, you've grown your funds to $410,905. That would be the red line in the middle there. If you backed a manager that can outperform, in the end, you can see the difference is huge, okay? $1.5 million, okay, is what you would have. You'd protected your capital and grown it over time. Remember, just an initial $10,000 and then $500 monthly from there on in. If you do nothing and not nothing, if you save that amount and stick it under the mattress and get 0%, you've got $130,000 saved at the end of 20 years. When you account for inflation, that will buy you maybe a cup of coffee. Okay, slight exaggeration, but you see the point. You will have not only it looks like you haven't lost any money, but you really have when you take into account the expected loss of purchasing power. Moving forwards. Okay, so now why Crassus? So you got all these other funds. Why would you copy the Crassus investment fund? So it's run by the fund's largest investor. That's me, by the way. So the benefit that is for you is that our incentives are aligned. So I'm the fund's largest investor. I stand to lose a lot if I do something stupid. So I have no incentive to do something stupid. I'm looking to maximize the growth. So protecting my capital which is really your capital in terms of performance, and growing that over time. I've had proven success in the private market, so I'm not someone that just went to university, to business school, and walked out and said, oh, I might start a fund. I have been an entrepreneur my entire life almost, and I've had various different businesses and various different real-world experience. I ran my own enterprise for many years, did extremely well out of that with a leverage buyout and then selling the enterprise. And so I really enjoy entrepreneurship. It's been a journey, and now I'm focusing my investment focus on public markets instead of private markets and real estate. Value fund. So our fund strategy, we buy assets for less than what we think they're worth. Okay, it's a strategy that's time tested. It's a little bit boring, but at the end of the day, who cares? As long as you're doing what you wanted to achieve, which is protect your capital and grow it at that particular rate over time. We have a strategy to outperform over the long term, and part of that is to get our fundamental valuation, work out what something is worth, how much are we able to pay for it based on the market price, and if there's enough of a gap between the two that's going to project and promises 20% IRR or year-on-year growth, we buy it. And if it gets more than that, we sell it. And if we can't buy it for less than what it's worth, we don't buy it. Very, very simple stuff, guys, but it's so effective. We have the ability to hedge and to leverage. So it is essentially a hedge fund. I don't particularly dip in and use a lot of hedges or leverage, and that's because generally over the longer term that's a losing gambit. However, it can be used intelligently as a defensive measure. So protecting your capital and smoothing volatility through turbulent times. So when you have some ups and downs in the market, I have the ability to sell short or to hedge and to use leverage where we don't have to use as much cash, but get a same size position. And so I'll talk about a few examples where we've used that to great effect. That can also boost gains. So it's all about outperforming the benchmark, outperforming the broad index. We can use it, those two tactics, to outperform. Okay, we don't often use it, but as I'll show you in a second, some examples of when we've used it extremely well, and it's certainly paid off big time. Using eToro and copying Crassus, you have access to global markets and diverse assets. So I'm a global thinker, I'm a global investor. I've been very fortunate to travel around the world as early as a young kid. I'm polylingual, and so I love learning about different places, and as always, as the investor, I'm seeing investment opportunities if they're there, okay? And so that allows us to find relatively unknown bargains. Everyone's, I get comments on the YouTube channel, people saying, I'm just not interested in those particular stocks. I love your analysis, but, they're just not stocks I'm familiar with. And that's the point. That is the point. Where do you think the bargains are? Okay, it's where everyone's not looking. It's where people aren't thinking about, okay? Places all around the world. And with eToro, you get access to Russian markets, European markets, Asian markets, so on and so forth. So we get access to emerging market growth, which is where some of those huge runway opportunities for growth are. And being a global-minded investor, we take a look at those. We get access to currency diversification. So we can invest on the London Stock Exchange, American exchanges, and various European exchanges, Asian exchanges that I mentioned. And eToro, I believe, will continue to build out the available stocks on different exchanges as they start to grow their user base. Okay, so that all sounds good, Ben, but show me the data, okay? In God we trust, but all others bring data, as they say. You can go on the fund on eToro, and you can literally just see the history. That would be my preferred way to do it. But some examples to illustrate the points I just made. We're currently up 2.8% on the month, okay, whilst holding 11% cash. So that is a massive risk-adjusted return. So if we were to annualize, call it a 3% return for the month, we haven't finished the month yet, we've got a week to go, then that would be a 36% annualized return without even deploying all the capital. Okay, so far the outperformance is looking good. Gazprom is up 35%, and that's another reason why we're thankful for global access. People didn't want to think about Russia, and yet you had this sitting duck of an opportunity there where the company was paying out like high teens in dividends and was worth, I still think it's got another 50 to 100% on the upside. Hedging protects our downside against, in this case, rising interest rates. So here's an example of where I have used hedging that smoothed out the volatility. I expect some interest rates to rise as the Fed in the US tapers. So what I did was take out a short position against the 10-year and the 20-year US treasuries and bonds. And so because we had some exposure to tech, when the interest rates rise, we expect the assets to drop in value. So one way I hedged against that was to sell short the 10 and 20 years. And so as interest rates rise and the yields rise, our value actually increases. So while the value of the stock or the trust that we've shorted, the bond trust, drops, we actually take a profit, which is pretty cool. So leverage has allowed us to outperform. Here are two examples. We made 36% and 24% gains for Vale and Freeport McMoran, respectively, in just 2 weeks. And that was with a small amount of capital, levered up, and that is a massive risk-adjusted return in only 2 weeks. Okay, I can't guarantee performance, guys. Okay, and none of this is stock advice. It's just to illustrate some of the points that I've been trying to make. But please don't mistake, past returns don't necessarily equal future returns. Performance isn't guaranteed, and anyone who does guarantee it is, they're probably someone you should avoid, in my book. Okay, so I take another moment here. This is a slide showing when I launched the fund, what I was aiming to do with the portfolio, why I was doing it, and what is the crux of what I'm trying to achieve here. So what I'm trying to achieve is to build a machine in which you can invest and copy very easily, as we just mentioned, that is aiming to protect your capital, number one, first and foremost, and grow at a target of at least 20% year on year. Now, it doesn't mean every year you'll grow 10%, but over 10 or 20 years, if you work out the growth from finish to start, on an annualized basis, we want that to be at least 20%, okay? The reason being that would roughly double our invested capital at a rate of every 3.6 years. How I get that is an old accountant's trick. If you take the number 72 divided by the expected rate of return, you'll have the number of years to double your money, okay? And obviously to outperform the benchmark, which for us is the S&P 500, okay, major American index. Because if you can invest with me or in the index and the returns are the same, well, why would you take the risk of a manager when you can just buy the index? So I have to outperform the index, and so far we're on track. What I would love to see is our hypothetical investor that invests 10,000 initially, and then even just 500 a month, okay? A contribution over the years, consistently, month in, month out, through the good years and the bad years and the sideways years, and eventually, over time, you see this outperformance. And if we were able to achieve that, that particular investor, hypothetically, would have over 1.5 million by year 20, okay? Which is obviously, that's life-changing. It's going to be a huge benefit to anyone that can achieve that. So that's what we're looking to do at Crassus Investments. That's what I work so hard to set up. If you're interested in copying the portfolio, I'll leave a link down below, and you can go on there, download the app, and add some funds if you wish. If you're not ready, no problem. You can add us to a watch list and just keep an eye and see how we're doing. If you don't want to invest with us or with me, great, no problem. But make sure you do invest somewhere, okay? Look after yourself and look after your family, okay? You must do something. And above all, make sure that you take care of what's important, which is you, yourself, and your family, and that you become independent over time. Okay, you don't want to be reliant on anyone else, especially the government. Thank you to those who have liked and subscribed to the YouTube channel. If you could do so, that would really help me get this message out there. That's my mission, is to help people become independent financially because of all the reasons that I mentioned, okay? Mental, emotionally, spiritually, economically, all those logical and emotional reasons as to why I want you to become independent. Disclaimer, again, as I've mentioned, this is not advice. I don't know your particular situation. This is what I'm doing with my funds, and this is a vehicle which allows you to copy that if you wish. But at the end of the day, you're responsible for your decisions. You're responsible for your actions. So make sure that you take that seriously and that you really do your own due diligence. I think the longest video I've ever done, but it's the most important to me personally. Hopefully that got across through the camera. I wish you all the best, and not just in your investments, with your life. And I hope that, if nothing else, I've inspired you today to realize the virtues of being able to invest, as opposed to, leaving it for tomorrow, and then 20 years later you realize that tomorrow never came, you never got around to it, and you're poor, helpless and destitute. That's really no good, and I don't want that for you or anyone, and I really want to see you succeed. Thanks for watching, and I'll be back with the normal video format for an investment review, and I'll see you then. All the best, Ben.